Hey, what's going on, everybody? Welcome back to the Land Development Podcast. We have an industry news episode for you today. That's where we pull up a few different headlines and we talk about what it means for the land development industry. Now, joining me on these episodes, as always, is Charles Covey. What's up, Charles?
Hello, hello.
All right, well, that brings us to the first segment of the show, and that is from the comments. So let's get into the first one, which comes to us from TikTok. This one is from Will Sia 21, and this is in response to one of the videos that we put together from our conversation with Peter Schiff a couple weeks ago. And this one reads, "No, we do not need to cut entitlement, raise the corporate tax, raise taxes on the rich, cut defense spending by half, raise wages, stock price gouging, and hold prices steady for 5 years." Seems reasonable.
Fascinating. Fascinating.
Uh,
I always wonder because I want to give people the benefit of the doubt, right? Maybe there's a particular thing that they're thinking about here that has merit, but sometimes it's just they're just spewing. And I think a lot of times this is more a reflection on the problems that are going on in their world and the challenges that they're having more than a reflection on us at all. But I don't think cutting defense spending by half as a blanket statement is probably practical. Do we need to be more efficient in our government? Absolutely, for sure. We might even be able to run the same military with half the spending. I'm not sure. There's a lot of waste going on there. So they're not wrong with some of these points, but some of them just don't quite make sense to me.
yeah, I think the one that stands out to me too on this is when you say raise the corporate tax, raise taxes on the rich, but then also in the same sentence you say raise wages, and then you take a step back and you think, okay, who are the people paying the wages to you? And if
Hmm.
they're paying more in taxes, how are your wages also going to increase?
Exactly. This
Yeah.
seems like from an economic standpoint, this could be a challenging one to pull off.
Yeah. All right. Next one comes to us also from TikTok. This comes from Daniel 37383649384. I'm not sure if that's a person or a bot. Who knows?
Yeah,
But
good question. Yeah.
But his comment is some key misunderstandings here. There is no investing without someone else taking on debt. If you want to build factories, you need to incentivize those investments, which high interest rates won't do.
Well, he's not wrong in principle here. So I think that is if we're going to have a an onshoring of a lot of manufacturing as Trump would wish, then you've got to have dollars cheap enough to make that make sense. So in generally, that he has a fair point here.
Our last one, this one comes to us from Spotify. So if any of you are on Spotify, not sure if you realized it, but each of the episodes give you the ability to add comments to them. So you can leave comments there and we'll see those. This one comes to us from the user A3, and the comment reads, "This is the best and most detailed and informative economic slash news podcast that I've heard from the Land Development Podcast. Please have Peter on more often. Could he be a recurring guest?"
I think we would love for him to be a recurring guest. I think he's pulled a lot of different directions and a challenging person to get. I mean, it was challenging to get on one episode just based on his schedule. So to get on multiple episodes, I mean, it doesn't hurt to ask, right?
100%. No, I like it. I think we got a lot of really good feedback on that episode with him. And, we've got a lot of others that we're working on getting on the show too that I think will also provide some tremendous value. But hey, with this said, if there is somebody that any of you listening would like to hear on the show on certain topics, just shoot us a message at the top of each of the show notes or in the description of the episode. There's a link there where you can send us a text message. And so if you have a guest or a certain topic that you want covered on the show, hit us up, let us know, and we'll see that and see what we can do to get some of those people on the show as either a special episode or maybe somebody that we interview. All right, well, let's go ahead and get into today's topics. Before we get into the actual articles, we have a housing market update. So the new residential construction March 2025 data was released just last week. And so here are the numbers for you. So those of you who are listening in and not watching, we have the graph up here on the screen that shows what this looks like from permits, starts, and completions going back to March 2020 all the way through March 2025. Now, in March 2025, building permits were at 1.48 million. Housing starts at 1.3 million, housing completions at 1.54 million, and then the data for the month of April will be available on May 16th, 2025. So we'll touch on that later. And a few quick notes on the housing starts and housing completions. So single family housing starts in March were at a rate of 940,000. That's 14.2% below the revised February figure of 1.09 million. And this is also an 8-month low. And then housing completions, 3.9% above the March 2024 rate of 1.49 million. And single family housing completions in March were at a rate of 1.02 million. And that's 0.9% above the revised February rate of 1.02 million. So it seems like starts were down and housing completions were actually up. Thoughts on this, Charles?
Yeah, I think that should be expected. We're seeing the stock build, and going into, unless we saw, there's some uncertainty about the spring selling season. So we may see those numbers pick up if the spring selling season goes well. But generally speaking, we're not trying to build into the slow season of the fall. So it doesn't really make sense to have high starts right now, especially with the stock of what's on hand. So this is expected. If this was growing, if we saw housing starts growing, I would be concerned because of what that's going to continue to do to this building pipeline of homes that are available.
Cool. Let's go ahead and get into our articles for today. So first one comes to us from Fox Business. Headline reads, "Housing is a national emergency." Anthony Pompliano, the Big Money Show panel, analyzes the state of the housing market. So we have a video for you here from Fox Business. We're going to listen to this short video and then we will discuss.
Housing market is flashing red. Adjustable rate mortgages, the kind that helped blow up the economy in 2008, are now being used at the highest rate in over 2 years. Why? Well, mortgage rates just spiked again, up 20 basis points in a week. New single-family homes for sale in the U.S. surging to 500,000 in February, reaching the highest since November of 2007. But even with more homes for sale, buyers are pulling back. Spring is supposed to be real estate's boom season, but Anthony Pompliano, you say that we have a crisis on our hands. We need to treat it like one. What do you think the path forward is?
There's 4 data points that really show this. The median asking home price is up 6% to $424,000. That's $50,000 increase since the start of the year. The median sale price in America is up 3% to $383,000. But I think even more importantly, the typical home buyer monthly mortgage payment is up 5% year over year to $2,800 per month. And so if you think about those numbers, basically what you have is you have homes becoming more expensive. You have debt becoming more expensive. We're not building enough homes. And so naturally you have this squeeze that's occurring. But people also forget at that same time you have real wages falling. And so people basically can't figure out how to buy a home or keep up with what is ultimately the real inflation that they're experiencing. And so the reason why I say it's a national emergency is because the federal government really has to step in here. And if you go and you look at the housing problem, we can't build houses in America, not because of the federal government. It's because we're being held hostage by local city councils that are basically, parading around or masquerading around as politicians. But at the end of the day, what do they know about housing zoning? What do they know about housing rules?
What do you mean when you say you want the government to get into it?
I think that the federal government
made a mess of it.
I think that the federal government should step in and say that we are going to create either some sort of sandbox, some sort of safe zone, or we are going to actually put some sort of guidance out for these city councils. Because what ends up happening is if you want home prices to stop going up so fast, build more housing. But what you can't do is you can't have people who they are not experienced and frankly, they have a lot of times very big conflicts, right? If you go to the local city council, who sits on the city council? Usually people who are real estate developers or are sitting there, they own real estate in the jurisdiction. There's tons of conflicts of interest. And so if you want the housing rules to actually change,
just crooks.
If you want those housing rules to change, what you have to do is you have to create some sort of guidance. And so the local rules that are in place right now are not taking into account the fact that there is a national emergency in terms of housing prices.
prices and mortgage rates, and you put those all together and we've got a disaster. I think President Trump wants to work on it, but I also want to talk about on the mortgage side how we got here, because over the course of the last 4 years under Joe Biden, the interest rate when he was inaugurated on the 30-year fix was 2.77%. It rose to 6.77% by July 18th of 24. It went back down in September of 24 to 6.08, but we've been bouncing around in these high ranges, making that prohibitive too for quite some time. That was inflation and the Fed.
But it was 7% last week, according to Mortgage Rate Daily.
I'm not denying it's not high.
Because people were dumping U.S. Treasuries. Now, the yields have eased on the 10-year Treasury, thank God. But again, if you create a Treasury crisis and a U.S. debt crisis, that impacts home buyers.
So we've got supply problem, we've got interest rate problem, we've got a big mess. And Donald Trump has made home building and housing a priority through one of his executive orders. But you're right, Anthony, it is a problem at the local level, and that is quite a mess to weed through. But we're going to follow it.
So speaking of Trump, I do have one more short, less than a minute clip I want to play before we react, because it has to do with the interest rates and his stance on interest rates and what he wants to see.
Doing the job. He's too late, always too late, a little slow, and I'm not happy with him. I let him know it, and if I want him out, he'll be out of there real fast, believe me. The only thing that's gone up actually is interest rates, because we have a Federal Reserve Chairman that is playing politics, somebody that I've never been very fond of, actually. But he's playing politics. Interest rates should be down now. They should be coming down. In Europe, as you know, they reduced them, I guess 7 times. It looks like they're going to reduce them again and again and again. But our guy wants to play cute. I would say the Fed really owes it to the American people to get interest rates down. That's the only thing he's good for. And he would have an effect on that if he lowered them. And I think at some point he will. He's going to have a lot of political pressure, you know.
All right, thoughts on this, Charles? I know there was a lot there from that the first video to what Trump has to say and with interest rates.
Yeah. The interest rate thing is, he's right. The rate's got to come down. What I think is interesting is what the one speaker was talking about with entitlement and the costs. A part there that I think is important is we talk about this pretty often, is that in order to be affordable, we have to have a smaller form factor. And most cities are pushing back against density as opposed to welcoming density. And this density is required to get this smaller form factor, less square footage, more affordability. So there's the city either they won't do smaller than 50-foot lots, or they won't approve any more apartments because the balance that they want to have is a certain percentage, or they won't approve cluster homes, or there's many types of ways to do this in a productive manner. And because it maybe isn't the normal thing that the city knows, or it's a new idea, or a great one is the building that looks like a big house, but it's actually a 4-plex or a 6-plex. And cities are kind of just, they don't know what to do because this is a new thing for them, and they're not really set up. City councils are not really set up to tackle new things. It messes up the whole system. So he's right. There are ways to solve the issue. I don't know if the government stepping in is the way to do it, but I don't have another solution. Like anytime you get more government involvement, it tends to mess stuff up. This could be an exception, though. This could be an exception. I can't think of one off the top of my head where a federal mandate to state and local governments was productive. Doesn't mean it couldn't happen, though. Can you think of one? Is there one that you can think of where a federal mandate was helpful?
No, I can think of one that hurt like a few years ago.
Right?
Yeah. So I think that makes sense. And we've seen some of the states trying to pass legislation that does impact the municipalities. We've seen that in Texas with some
Texas is trying like hell.
Yeah,
absolutely. But you look at the examples. Florida's done this, though. Florida, they changed their zoning completely. It's commercial or it's residential. It's not all this chopped up different opportunities. Houston has done the same thing. You go to Houston, there is affordable housing everywhere. I think Houston is a great market for affordability. And the fact that they have dramatically reduced their zoning to make it very, very simple. It's commercial or it's residential. That's it. And guess what? There's affordable housing everywhere. So there's plenty of examples, but things like this is like turning the Titanic on a dime, and it doesn't happen. So because it's such a monster, that we're seeing the momentum though. Austin's done some big changes. There's a bunch of things that are trying to happen. It's like maybe, and that's a theory of maybe the pressure from the federal government would help kind of tip that scale. Like it's a lot of cities are considering it. It's just like, I don't know if we want to make this big a change. I don't know if they're going to reelect us if we do that. You know, those kind of concerns. So maybe some pressure from the federal government would tip that the other way.
Yeah, one quick comment here before we move on to the next one, just related to interest rates. I'm not some great economic mind, so I am fascinated by, we had Peter Schiff on, and he was talking about how he wants rates to go even higher because he feels like that's the only way to get the correction to happen that needs to happen. Whereas we know that's going to lead to, it's going to lead to issues in the market. And he admits that as well, that, hey, we need this correction to happen. And so I just wonder, with rates, with what Trump wants to do and trying to put pressure on getting rates to come down, does that delay the inevitable? Do we continue to ride this for a period of time, and then maybe in X number of years we have a crash or something? I just don't know how this is all going to play out. It just seems, hearing different people talk about it, they have different perspectives on, the economy's fine or whatever. But then, Schiff thinks we've been in this building bubble and it's just a matter of time before it actually all comes crashing down.
Yeah, I don't have the solution here, but there's plenty more conversation on this one, and I'm sure we're gonna find plenty more articles, and we'll talk about this ad nauseum over the next number of months and years. But there are solutions that are happening. It's just, it feels like it's not happening fast enough.
Yeah, agree. This episode of the Land Development Podcast is brought to you by Groove. There are a lot of mapping platforms out there, and if you're just looking to make a nice map, those might work great for you. But if you want something that goes beyond just the map, something that helps you actually manage the land acquisition workflow and track deals, then that's where Groove comes in. Groove's built around a map, but that map connects everything. You can prospect land, find ownership information, and see key parcel data right from the start. Then, when you talk to a landowner, add a note, upload documents, or drop in a photo, all tied to that parcel. Nothing gets lost in the shuffle. You can even bookmark parcels and organize them into folders to keep your research clean and easy to come back to. And with the built-in CRM, you can add contacts straight from a parcel record, then track emails, calls, meetings, and whatever comes next. Once you're ready to turn a parcel or a few parcels into a deal, Groove's deal management tools let you track everything visually on the same map. No new files, no exporting data. It all lives in one place. Groove centralizes everything: prospecting, research, CRM, and deal management, so you're not bouncing between tools or losing track of where things stand. And if you're working in Texas, there's a feature our users love. Click a parcel, and with one tap, you can view that owner's full portfolio across the state. It's huge when you're trying to uncover more opportunities with people you've already worked with. Start your free trial today at letsgroove.com/signup. That's letsgroov.com/signup. All right, let's get back to the show. All right, well, let's get into the next article. This one comes to us from CNBC. Headline reads, Blackstone President John Gray on Q1 results, President Trump's tariff policy, and the real estate market. So this one is another video, so we're going to pull this video up, watch this video, and then we will discuss.
First quarter results a short time ago. We want to get more on this quarterly performance, tariffs, markets, and so much more. I want to bring in John Gray, President and Chief Operating Officer of the Blackstone Group. You put a lot of money to work, even in the last quarter. So what is your thinking about where we really are?
Well, in terms of where we are today, we're obviously facing a more difficult environment. Everything changed on April 2nd. I think what we need is a little bit of perspective here. There's certainly a lot of pressure in parts of the economy where you're focused on input costs, manufacturers, retailers. There's now also, of course, market dislocation, which you guys see M&A activity, IPO activity, spreads going wider. And then there's the risk of this moving into the broader economy and there being more of a slowdown here. And all of these obviously create real challenges. But what I would say is, if you want to have a little bit of optimism in the face of all this, is it's not like crises in the past where we had the global financial crisis and we had trillions of dollars of excess debt that was out there. It's not COVID where we were all forced to go home and be in our pajamas and shut down big portions of the economy. This is policy-induced stress. And it can change very quickly. So I think this tariff diplomacy can move. And I think as investors, you've got to recognize that certainly the faster it's resolved, the better.
You're a real estate guy early on in your career. Now you oversee all of it. We've talked a lot about BREIT, your REIT product. The University of California CIO says the real estate recovery, quote, ain't happening. Are you in agreement with him?
I would say that the real estate recovery is moving forward. What I would say about that is when we talked about it a year ago, we said things were bottoming. We said it wouldn't be a V-shaped recovery, but it was all sort of falling into place. And we see that. What happens in a real estate recovery is prices fall. That's occurred. And then you see a real reduction in new supply. That's happened. Interestingly, the tariffs will make building even harder, so there'll be less new supply. And so just like the early 90s, we're in that period of time where the recovery's beginning after the financial crisis. The same sort of thing is happening. That's why you see us deploying capital. Buying hard assets at a discount at this point in the cycle makes a ton of sense to us.
Are there businesses that you own that are going to be materially impacted by the tariffs? Is there anything you plan to do about it, and what kind of impact it will have? And are there any assets that in this new environment you would say to yourself, either one of two things: we actually are going to reshore back into manufacturing from a portfolio company back in the U.S., or we're going to try to divest certain companies because, you know what, this new world is too complicated for it?
Yes, it matters where you invest, but I ultimately believe there will be some settlement here. This tariff diplomacy is going to land. I was encouraged by what the Treasury Secretary said earlier this week, that they're making good progress with trading partners. I do believe there's going to be a resolution here, and I think you have to recognize that, even if there's going to be some pain over the next 6 months.
So on this one, speaking of the tariffs there, I did want to piggyback on what he was talking about. And I pulled the latest news on tariffs and those conversations and negotiations that are taking place. So this one comes from Fox Business. And the headline is U.S. allies line up for trade deals during the 90-day tariff pause. Some 75 countries have now reached out wanting to negotiate with the White House on trade deals, and 15 countries are in active negotiations. So real quick here on a few of our key trade partners. So we have Japan, and the Japanese Economic Revitalization Minister met in Washington with the U.S. Treasury Secretary and the U.S. Trade Representative, and even had a sit down with the U.S. President, but left without a deal. Talks will continue. The Japanese Prime Minister has said he won't offer big concessions just to wrap things up quickly. Japan plans a package in exchange for full tariff removal. And then the UK, the US Vice President believes there's a strong chance for a great deal with the UK. The UK Prime Minister has already suspended tariffs on 89 US goods for 2 years and is pushing to cut the 10% broad tariffs and the 25% metal and auto levies. I'm not going to go and read the rest of these. I have some here on South Korea, Australia, Vietnam, and India, which you can see and read on the video, but also there's a link to all these below. I think the moral of the story here is that there is action happening. There's conversations taking place. And even this post right here from Peter Schiff, where that he put on X, where he says, rumors are that the U.S. is close to a trade deal with India. Under the terms, India will eliminate its 2.5% tariff on U.S. ethane, and liquefied petroleum. Trump leveraged 10% baseline and 26% reciprocal tariffs on Indian imports, plus who knows what else to negotiate that deal. So what are your thoughts, Charles, on kind of where we're sitting, what the Blackstone CEO had to say on kind of the market and what's happening?
But I think that he has a good point on real estate values. I don't know if he's right, though. I don't know if he's right. If he's right, this is a huge deal for them to be actively acquiring. If he's wrong, I don't think it's a bad thing. I just don't think it's going to be, the giant multiple that they might have gotten. If for some reason we see massive tariff effects on construction, because the reshoring of some of these things is just impractical and it would take a long time. So maybe it happens eventually, but you can't just build a factory and be, let's say it's toilets or tile or whatever it is. You can't just all of a sudden be making those in the US overnight. That would take a period of multiple years to get that spooled up. So then that, in theory, if these didn't get resolved, you'd have a short-term bump in cost of construction, in addition to what appears to be a relatively high interest rate environment. That could be challenging. That could make things more expensive, and then it would make prices right now actually seem pretty cheap. That's his best case scenario. I think he's still probably wise to put capital to work in real estate either way. My personal thought is, and I've been saying this from the very beginning, that most of the tariffs are posturing. The problem with posturing is that sometimes they call your bluff. And we don't know how many of those are going to be that way. I think it looks like China wants to go that route, and China wants to play chicken and see who blinks first. So that one's going to be fascinating, and whoever may decide to align there. Most of the countries realize that it's in their best interest to get a deal done. And so it looks like, by and large, we're getting the majority of these are going to be deal making, which Trump loves. I mean, he absolutely adores this process. We all know this. And so he's having a blast. And I think that once you have 75% of our major trade partners or 80% of our major trade partners with deals done, now that's going to be a pretty big thing for China to look at, be like, hey, we're now kind of on the outside. So it makes sense for them to be scrambling to get as many deals done as possible. And then that's the giant elephant in the room when they go talk to China. Hey guys, do you realize everybody else has already capitulated or already made a deal? Maybe capitulated is too extreme a word, because you don't want them to feel like they're getting a bad deal, but it's better for everybody to have a more open border policy with trade. And I think that China is, my guess is that, because you're looking at I don't know if you've seen the videos of the factories in China that are just shut down. I don't know how many of those I don't know what percentage of those are real and how many of those are just, for the gram or for TikTok or for the news. So I don't know how much of that is real. But if some of that is real, the pressure from those billionaires that own those factories up the chain to fix this problem is going to become pretty strong. And I get the Chinese are very committed to what is best for the country. Even if it causes them a little pain, that's fine. If it's best for the country, we're there. But that only goes so far. If it starts really completely crushing billionaires who helped get politicians in office, things start to happen. And that's just the way politics works. So I would say that China might be in a tough position. We will see. This will all play out over the next number of months, and I'm excited to watch it happen.
Yep, for sure. Well, let's get into the last article of this episode. This one comes to us from Globe Street, and the headline reads, "Shifts in consumer spending could ripple throughout CRE. Discount retailers, warehouses may benefit from economic uncertainty." Reading from the article, consumers appear to be shifting their consumption focus toward essential goods, with prices on recreation services, hotel stays, airfare, and used vehicles all growing more slowly. This trend is reflected in stabilizing prices and cooling inflation during March, according to a Marcus and Millichap analysis. Escalating food costs are contributing to a pull on household spending to cover daily needs. The food index grew by 3% year over year, driven by increasing restaurant and grocery prices, the report said. Grocery anchored and necessity based retail stand to benefit from this evolving demand environment. Continued cost sensitivity also will likely reinforce the tenant mix toward value oriented and discount retailers, it said. The report said demand for middle tier units could be driven by renters seeking affordability and higher income households delaying trading up. However, a thinning construction pipeline will also limit new options at the upper end of the market, which should cause occupancy in Class A properties to be stable. In the retail segment, price increases for apparel and furniture accelerated in March, possibly due to supply side repositioning and a modest pull forward of demand ahead of anticipated trade disruptions, said Marcus and Millichap. Retailers may use the 90-day tariff suspension to front load shipments, which could result in demand for warehouse and distribution space as inventory accumulates, especially near major ports and logistics hubs. Prices on new vehicles edged up slightly in March, but were mostly stable. Marcus and Millichap said this suggests inventory levels and pricing dynamics have yet to face significant disruption. Onshoring and reshoring strategies could gain traction, particularly in regions with established automotive infrastructure, but many manufacturers are expected to adopt a wait-and-see approach. The timing and scale of any shifts will depend heavily on future policy developments and expectations, said the report. Thoughts on this, Charles?
Yeah, a couple things. One that I think is very interesting is talking about retailers front loading, trying to get ahead of this 90-day window. And I think some of that will happen. A little bit dangerous, though, because we're also seeing consumption with certain goods trend down. I think there's just general uncertainty in the marketplace. I mean, we're in, depending on whose definition you use, I would say that we are in a recession. So it should show spending going down. You could get into trouble if you front load a whole bunch of stuff and now sales lag through the remainder of the year. That could be problematic. So we'll have to watch that one and see what that looks like. That could get people in trouble. The other part of this is that the onshoring, we're talking about, bringing all these things here. Nobody's making a move yet. We're not seeing everybody, scrambling to buy industrial dirt and, planning their new factory here. And we're not seeing that yet because we don't even know if it's necessary. If all this stuff shakes out and everything is just fine in 6 months, then you will not want to have spent a whole bunch of time and money trying to reshore items that you can still make somewhere else for cheaper. So there's a lot of hurry up and wait kind of process here of you definitely wish you could get the information sooner, but I don't think anybody has the crystal ball that's going to be very accurate in predicting what the hell is going to happen over the next 2 or 3 or 4 months. It could go so many different ways, but my take is going to continue to be that these things will get resolved. China's probably going to be one of the last ones, but if they stack enough pressure, probably caves. My guess is in 6 months, the tariffs are a non-issue or nearly a non-issue.
Well, that brings us to a close here. Any final thoughts, Charles, before we wrap up?
This is a good time. I'm having a blast. There's so many things going on that affect what we do on a daily basis. And as much as we would like to predict, we don't have enough information to make super high quality decisions 3, 4, 5, 6 months out. We can say what we would think might happen in a month or two, but there's a lot of factors at play here. So I would encourage everybody to stay tuned. We're going to try to find the best information that we can, the most up-to-date information that we can, and try to give you good tools for decision making.
All right. If you're not already subscribed to the show, make sure you click that button and subscribe. And also, if you haven't left us a rating and review, that goes a long way also in helping get the show in front of more people who are searching for land development content. With that said, thanks for tuning in as always, and we will talk to you all next week.